In this video, I'd like to dive deeper into qualified business for self mortgage applications. We're going to talk a little bit about what documents are required and how a lender specifically determines your income. Join me. So first off, why would a self-employed individual want to qualify under the qualified business for self mortgage product? And the answer is very simple. Those who qualify under this product get the benefit of the best mortgage rates and the most favorable terms and conditions. However, in exchange for those low rates and great features of the mortgage, the lender wants to see very specific information from you. And so we're going to talk a little bit more about what exactly the focus of the application will be. The focus of a qualified business for self mortgage application is almost entirely on your net personal income. So this is the number that after all the write-offs, all the deductions, all the creative tax solutions you show to the government. And of course, you want to keep that number as low as possible. Nobody wants to pay more income tax than they have to. However, this is problematic when applying for a mortgage because the lender wants to see as high a number as possible. Depending on how you operate your business, whether it's a corporation or you're a sole proprietor, this income can show up in many different ways. For example, if you run a corporation, you can pay yourself personally dividend income and maybe a T4 salary income. If you're a sole proprietor, this income gets typically reported on your business activity statement that shows up in your T1 general. So it's a very simple balance sheet that appears where you have your income that you've generated minus all of your expenses will show your net business income. In order to prepare for your business for self qualified mortgage application, there are really two things that you need to have in hand. The first are your two most recent T1 generals. The second are the corresponding notices of assessment from Revenue Canada confirming A, that the numbers on the T1 general have been reviewed by Revenue Canada and agreed upon, and number two, that your personal income taxes have been paid for the most recent year. Now, a mortgage lender is going to take those T1 generals and notices of assessment, and they're going to take a 2-year average to establish consistency year over year, looking at your past, to figure out what a reasonable income for the current year is and for your mortgage application. Now, if life is perfect and there's consistency, that's awesome, but we know that life isn't so simple and that businesses can have fluctuations, especially as you're building your business. So this can present some challenges, and that is why we have a second category of mortgage qualification for business for self borrowers called stated income. So usually at this point, I get some pushback from individuals who are self-employed and say, well, look, I run a corporation, I own it 100%, and I have profit or retained earnings showing on my books. Isn't that my income? And yes, it is. However, from a mortgage lender's perspective, again, the focus is entirely on what you pay yourself personally, not in your corporation. So that income won't be considered under a qualified business for self mortgage application. Ditto if you're a sole proprietor. Of course, when you start doing your write-offs, there's a lot of personal items that can be written off under the business. And so those items don't necessarily get added back. In some cases, the lender will consider some of those items, but in general, the lender is looking entirely at the net amount after all those deductions. Now, if you are self-employed or would like to explore mortgage options, drop me a line. My name is Chris Mulder. I'm a Toronto-based mortgage broker, and I look forward to hearing from you. Bye for now.